Welcome learners. In today's session, we'll explore key reforms in the Indian banking sector, from infrastructure financing to NaBFID, NARCL, and the ease reforms that transformed public sector banks. Infrastructure is the backbone of any economy. It requires heavy investment, has long gestation periods, and creates externalities. Because of economies of scale, many infrastructure services are natural monopolies, hence government regulation is essential. Quality infrastructure drives faster and inclusive growth. It empowers MSMEs, reduces poverty, generates employment, boosts productivity, and expands both domestic and foreign trade. Without it, development stalls and costs rise. Government classifies infrastructure into sectors like construction, electricity, gas, water supply, railways, roads, telecom, ports, irrigation canals, sanitation, and more. Each sector is vital for holistic growth. India's savings rate is high, but channeling funds into infrastructure is the challenge. Financing comes through government, DFIs, commercial banks, NBFCs, insurance or pension funds, external borrowings, and FDI. Key traits: long maturity, 5-40 years. Large amounts, hundreds of millions per project. High risk, policy, demand, environment. Low but positive real returns. To address infrastructure financing gaps, India established the National Bank for Financing Infrastructure and Development, NABFID, in 2021. It acts as the principal DFI for long-term infrastructure projects. NABFID lends, refinances, attracts private and foreign investment, facilitates dispute resolution, and develops bond and derivatives markets for infrastructure financing. NABFID has ₹1 lakh crore authorized capital. Initially 100% government-owned, later reduced to 26%. It raises funds via loans, bonds, debentures, and support from RBI, banks, and multilateral institutions. Government provides grants, guarantees, and FX risk cover. To tackle NPAs, India set up the National Asset Reconstruction Company Limited, NARCL, in 2021, alongside IDRCL. NARCL aggregates stressed assets, while IDRCL manages resolution. PSBs hold majority stakes. Banks transfer bad loans worth ₹2 lakh crore. Phase 1, ₹90,000 crore of written-off loans. Phase 2, ₹1.1 lakh crore. Sale is 15% cash jor 85% security receipts, backed by government guarantee of ₹30,600 crore for 5 years. Public sector banks dominate India's banking landscape. To improve efficiency, the government launched the EASE Agenda, Ease of Access and Service Excellence, in 2018. Each version deepened reforms. 6 themes: customer responsiveness, responsible banking, credit offtake, MSME support, financial inclusion or digitalization, and HR development. Introduced loan management systems, early warning signals, recovery arrangements, and outcome-centric HR. Responsible banking and MSME support showed maximum improvement. Focused on digital transformation, Dial A loan, end-to-end digital lending, analytics-driven risk management, cloud banking, and governance reforms. Rolled out in 2021-22. Added 24/7 resilient banking and collaborative banking with NBFCs. Emphasis on digital payments, doorstep banking, and agri-tech partnerships. Launched in 2022 as part of EASE Next. Common Reforms Agenda plus bank-specific 3-year roadmaps. Focus on new age capabilities, evolving customer needs, and deeper digital integration. Infrastructure financing, NABFID, NARCL, and EASE reforms together strengthen India's financial system, ensuring stability, inclusivity, and resilience for future growth.